Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of August 24th, 2025. And in this week's episode, it is a searching and learning episode. So I myself, Sprocket888, joined by Viperxl007, and I'm going to talk a little bit about my searching for earnings trades next week, just to go through a really brief kind of thought process on where I'm going to pick my strikes and how I'm going to approach an earnings trade. And Viper, as you know, has been really going on a little bit of a learning journey, tracking different trades that he's been putting in. And so we'll just get an update from him on where that stands and what he's learned and what he's kind of continuing to learn and what's he embarking upon. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what content you're interested in and love to hear what you're trading out there. Also, you'll find a link to thetagang.com/Sprocket888 as well as /Viperxl007. Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, I kind of want to start out with just a little bit of, what's happening in the market, and it's earnings season right now. And earnings season is one of my favorite seasons. It comes around 4 times a year, which is super awesome. And I've just kind of been putting on different earnings trades, and I have a couple things in management that I've been kind of waiting to pull off, and it's been going pretty well and pretty decent. And I know that you have kind of been touched on different strategies and things like that. And I really feel like the market is picking up a little bit of volatility this week. This most recent week of trading, I won't say a ton yet, but we have now stretched up. I don't know if this is the 3rd time that we've come up to really approach market all-time highs therein, but largely we have fallen off of those all-time highs yet again. And I don't know, the selling seems to be a little bit more voluminous this time, and the VIX and some of the volatility has kind of ticked up more than it has in the past. So, could be a nothing. We could be back to all-time highs again in the not so distant future, but I don't know. Are you feeling that anything is a little bit different on this pullback at all? Or is this just kind of another one of those pullbacks that we've kind of been iterating through for you?
So I don't, this is just as you were saying that, I was realizing in my head, I was like, oh man, like as we're going to see in a little bit here, like I'm very active and I have no idea where we're at. And I kind of love that because that's definitely my goal in a lot of my strategies is to be directionally agnostic. I mean, I'm still taking directional trades, but my strategy is to have both bullish and bearish strategies that I'm deploying. And the fact that I have no idea which way the market's going, I think means it's working because I'm taking my cues, I'm taking my screeners, getting my trade data, and just taking the trade. And based on the screener criteria. But I will say, I have felt upwards momentum recently, and that's because the vertical spread strategy that I've been working on, getting some data collected on. Those are, I talked about this last time. Those are a much higher win rate than they're supposed to be. Granted, there's only 4 trades there, so this is not a real data set, but they should have like a 40 to 50% win rate as we looked at on the P&L chart in my brokerage. So that tells me that things are moving, which I think is aligned with what you're saying. So I'm getting into profit scenarios consistently with that. That's not supposed to be the case. So I'll take it. So by association, I guess I've felt it.
Yeah. So Viper, I want to take a stop here and take a look at just real quick kind of earnings are thing I always trade, and one of the things I don't think I really talk through. I post in the Discord what upcoming trades I'm kind of looking at for a week, but I just want to take you through one example of where am I picking my strikes? Am I doing a strangle? Am I doing a short call? Am I doing a short put? What am I going to do there? So let's take a look at that. All right, so this is the screener that I look at. Not going to go through this. I've gone through this in different episodes. What I want to kind of call out is I sort it by implied volatility percentile, IV percentile. The first is MDB, MongoDB. That is a great example. I have played MongoDB on many earnings, and it repeatedly has a excellent volatility contraction. So we're going to start by looking at MongoDB. So here is the chart of MongoDB. And now when I'm looking at this, so MongoDB is going to have its elevated premium. I already know it's liquid. I know this is one that I like to trade. And so I'm going to look at the chart to see where is this in its price action. You can see back here in December of 24, we were up at an all-time high of 370, at least all-time high within the past year. We've really fallen off. We had a couple of gap downs on earnings. These had excellent volatility contractions. That's awesome. Here was a gap up on earnings, but it kind of fell off from there. And you just kind of notice it's went on a little bit of a steady uptrend. So right here, we're not seeing anything explosive. We're not seeing anything, super crazy. It's a nice steady climb. I'm going to look at the RSA down here, and the RSA is going to show me, it's a little bit on the bottom end. I tend to prefer strangles when we're stressing the top end of the RSI, sorry. The reason I do that is because that there's more of a chance, in my opinion, when you're up on the upside of the RSI, that if you blow through the top side on earnings, you're more likely to come back in kind of a retreat back to the median. Whereas if you're on the bottom side of the RSI and you blow through your top side, sometimes there's more running room to go up. So I'm more cautious, but the volatility that is packed into MDB here, MongoDB, and the fact that this is kind of a nice steady rise. We've got the indicators. We're really approaching this crossover of the 200-day moving average, which is something I kind of look at. This really is showing me that we're probably in the middle of a decent range here. So to cross over this 250-day moving average, it's going to give some hesitation. So it's not going to go super high above that. I mean, it could, but then you might retrace and bounce off of it. The fact that this is kind of in the middle of RSI, it's a little bit on the bottom, a little bit below 50%. So it's kind of right there in the middle. This definitely would necessitate a strangle. If I saw this RSI kind of bumping along the bottom, like back here, where you're kind of dancing along the bottom, and if this was what it looked like going into earnings, I would be more inclined to take this as a bullish only trade, meaning only selling puts. And so I really try to keep my earnings trade around a 30 delta to 40 delta trade. What that means is if I'm going to play the top and bottom side, I'm going to split that difference and do a 16 to 20 delta on the put side and a 16 to 20 delta on the call side. If I'm only going to trade one direction for earnings, I will take about a 35, maybe up to a 40, but usually I'm between 30 and 35 delta trade on that side. So if this was just a bullish trade, I would probably look at about a 35 delta for this option. But because I'm going to take both sides on MongoDB, I'm going to probably look at the 16 to 20 delta on the put and the call side. Now, in this case, because I see a little bit more risk to the upside, just based on where it is in the RSI, I might actually probably target a 16 delta on the call side and a 20 delta on the put side. That gives me a little bit more room to run on the upside before I'm breached, but it still gives me decent premium on the put side. And so that's really just the small nugget that I wanted to kind of add, as there's no science to this per se, but to me, this piece of looking at the price action has really kind of been an improvement, a small improvement or edge in my trading style, because I think it's really helped me get to where when they're breached, there's a higher probability that they're going to come back in and I'm going to be able to turn that trade faster because it's a little bit more price action taken into that account. So that's what I wanted to just touch on very briefly here. There's multiple episodes where I've covered my criteria and all of that stuff, but there's not a lot of things where I've verbally thought out or talked through what does the chart look like and how am I picking my particular strikes. So Viper, before you hop to your learnings and stuff you've been dealing on, does any of that strike you as something that you've kind of been exposed to, or how you've kind of maybe considered, or how I've integrated some of that technical analysis or price action?
Yeah, no, I think it's very sound, and it seems to produce, because I think, correct me if I'm wrong, I mean, this is how you've been pretty much filtering for most of this strategy, right?
Yeah, definitely. This is the way, and a lot of times, you'll see the notes that I put in there on the Discord about what I'm looking at, but I never really explain. Well, how did you just choose to do a strangle on that? How did you choose to do just a put? What were you in there? And that's really a visual thing. There's really not a numbers thing that backs it up.
Yeah. So yeah, I think it's very technically sound, and what I like about it is obviously the consistency, and the understanding of everything that goes into it, and what's backing it, and why it's important to watch it. And as I guess my journeys will continue to call the Edge season, the Edge series. And I think that captures that very well, because that's literally what finding an edge is all about, is just have a key set of data points that help you exploit something in the market. And that's really, as I'm on the current trajectory that I'm on, that's a huge part of what I'm doing, and then what I'm taking in as far as material and whatnot. It's find a niche, find something that lets you exploit an outcome. And so I think that all comes together really well, and is pretty apparent in your strategy there.
Yeah. So what have you been up to? What kind of learnings are you kind of coming across? I know you've been slowly slogging away at login trades, but where things stand for you?
So it's interesting because obviously, as I've shown multiple times, and we'll get into it in a little bit here, I've been logging every single options trade I take in this custom dashboard that I put together. And I'm at the point where I'm really glad that I've done that. I'm really glad, obviously, that I'm logging everything. We always talk about that, but I'm also glad that I've, and again, I guess I don't want to get too caught up on this, because no one should have to build what I built. This was literally just, it was exciting. It was part of my passion. That's why it came to be. This is not a requirement at all. The requirement is logging. Anything, pad and pencil, spreadsheet, whatever you want, whatever helps you. And the reason I'm drilling on this is because the way that I've built my logging is exciting to me. And so it was fun to build, and it's fun to use. Therefore, I'm going to regularly use it. And so I'm at the point where I've taken a fair number of trades. I still want a larger data set, but it is creeping into like, okay, there's actually some trends here, and there's some learnings we can take out of this. So, and the reason I did not expect to enjoy having this data is it does not feel like when I think about how I'm doing on my equities trades, it doesn't feel great. It feels kind of a mess. It feels kind of, yeah, this one was good, this one was good, and just mentally remembering what I've done, it's like, I don't know, is this working? So that's where this data really comes in handy to bring me back to center, because you're not going to remember every single thing. And so seeing the data, I look at it and I'm kind of like, whoa, I mean, really? Like that's what we're doing. And so that's kind of what I wanted to go over as far as what's been hot on my radar lately.
Actually, one thing you said in there, Viper, really resonates with me. You probably didn't expect it, but when you said it doesn't feel good when you're trading, that is actually one of the first observations I actually had as well when I was logging a bunch of my trades. And very early on, we talked about why that's so important. And it's because your brain will not recollect all of the things in between. You will have one or two standout trades, and those might stand out very positive for you, or in my case, very negative. You just only feel the bad things feel a lot worse and they linger a lot more than the good things. And it wasn't until I looked back at my own logs, which weren't fancy like you. It literally was just a spreadsheet with a couple of columns and many rows, where you look back and go, actually, there is a little consistency trend here of little green, little green, little green. But in my brain, I was only really remembering a lot of the red. So that definitely resonates where you have that small little recollection. Your memory is actually serving you, not the complete story, if you would.
So, I mean, exactly. Like, and this is really captured, I think. So I want to walk through it a little bit here. So this is my top level statistics summary. So this is just summarizing everything I've done. As we can see here, I've taken 74 trades to date, and that goes back to March, mid to beginning of March, and a 59.46% win rate across those 74 trades. Yes, we're in the red. Negative $250 loss. Profit factor, not great, 0.93. Expectancy, not great. Expected value per trade. The Sharpe ratio is 1.907 though. So two things jump out at me right away. Obviously that win rate. I mean, that's pretty great. It's certainly what we always talk about being in above 50% win rate. And the Sharpe ratio actually jumps out at me as well. And particularly because the strategies that I'm honing into, with the vertical spread that I talked about last time, that strategy really bakes in a very crystal clear profit risk reward ratio. So at a very high level, it's buying vertical spreads, either calls or puts. And so since I'm buying the spread, that's an initial debit. That's an initial cost. That is the max loss realized up front for as long as the spread stays together. And so the thing that jumps out to me about the Sharpe ratio is that it kind of is the inkling that this might be working. So the reason that I'm doing this vertical spread strategy is I can easily dial in a risk to reward ratio by how that spread is structured. And I'm tending to structure these on at least a 3-to-1 reward to risk ratio. And they've gone as high as 5-to-1 on some. And so this Sharpe ratio is telling me that per unit of loss that I'm risking, I'm also at a ratio of 1.9 profit. And so right now pushing on a 2-to-1 risk to reward ratio, which is pretty great. That doesn't obviously mean that I'm in profit, but it's a nuanced layer of the data that says I'm on target with win rate and I'm on target with my risk. So that's pretty solid. Now I got to work on the other part, which is down here. If we look at the P&L over time, I mean, this is why it feels bad. I think this is pretty clear that, I had a brief in the beginning, early June, I had a brief spike up here into actual profit, and then we just tumbled downhill, and we're down here, and now we're climbing our way back up. So I think this brought it all full circle because, like I said, it doesn't feel great. It doesn't feel like I'm doing a good job, and the data seems to back. Well, there's merit to that feeling. Like, I mean, we're slogging through the loss here. But the data has this ray of hope of like, no, I mean, the strategy's working. There's just things around it that need to be tweaked. And, right off the top of my head, I know that the first half of this chart into the first chunk of tumble here, like this, we did an episode. I explained this big cliff drop here. That was a bunch of calendar spreads that I held on too long. I broke the rules of that strategy and realized a loss that was bigger than it was supposed to be. And so what I think is most interesting here is the most recent action here, where I have kind of paused. Like I said before, I paused the earnings strategies and I've settled into this new vertical spread thing and a daily SPY trade. And the whole purpose of the daily SPY trade is consistency through daily action. And that is playing out so far. I've taken a couple losses on that strategy, but it is the slow grind. It is not a home run knocker play. It's literally for one contract. It's max profit around $30 to $60. That's the expectation. Loss similar. And that's it. It's the whole thing is just consistency every day, and getting the laws of large numbers in your favor. So that's good to see that stacking up. The big jump that we see here, that's one of the vertical spreads popping off. That was a fantastic one, but that goes back to that Sharpe ratio, because that vertical spread that specific one was on the order of the 4-to-1. It might have even been a 5-to-1, and I hit max profit on it. And so that was the whole purpose of that strategy. Is it's supposed to have a 45% win rate, but that one win just paid for, if it was 5-to-1, it paid for 5 losses. And so now a 45% win rate could still be hugely profitable if we're nailing that 4-to-1, 5-to-1 risk to reward ratio and combine that with the win rate. So the other things that jump out on here are just kind of, like I said, the calendar spread, the earnings trades I was taking had the 58% win rate. I talked before about how those trades just weren't, they were too erratic on position sizing. And I think that really shows itself in the net P&L here. If I switch over to my daily SPY trade, I've taken 18 of those. So still small data set, but we're getting there. And it has a 66% win rate, and a very modest net P&L. But I do know that there were a couple pretty sizable losses in there. And so multiply that out over a year, or more. I mean, that's the whole point of this strategy. It's just this slow grind, and every now and then you get knocked down, but then So, all in all, I'm actually feeling a lot better by reviewing this data. And like I said, it's at a point where I can start to make some decisions based on it. So right off the bat, obviously one of the decisions is we're going to keep focusing on that vertical spread and the daily SPY. Those are the two trades that I'm going to focus on, the two parts of the strategy. And earnings, I think, are on pause for me for a little bit until I can get some consistency. To your previous episode about work balance, that's really a struggle right now. It's hard for me to even get that daily SPY trade on. So the vertical spread is going to work a lot better for me in the short term, because that's a set it, and it's about a 10 to 15 days to expiration trade. And I just got to set a reminder 2 to 3 days before expiration. Hey, go clean these things up and get out. That's all there is to that strategy. So it makes me feel a little bit better that when I actually review the data as it's logged and not as it's remembered, things are looking pretty solid.
Yeah, that's great, Viper. I'd actually call attention to your Sharpe ratio, which jumped out to me. That's actually a really good Sharpe ratio. I think kind of in the order of professional risk to reward ratio as far as trading goes. So just as a point of reference, I think my current Sharpe ratio is like 0.45, maybe 0.5. And I don't typically ever get over 1. If you want another point of reference of some other schmuck on the internet, I think we've talked about this in the past. I believe Warren Buffett, everybody knows who he is, I think his Sharpe ratio typically sits around a 0.75. So that's actually a good, very respectable number, Viper.
Nice. Well, the trick is to keep it up, but I do think it's a function of what I'm doing, and as long as I continue to do that, then I think we'll be in good shape.
Yeah. I guess maybe you'll have to go to paper trading or something on earnings, because you can't really hit pause on something until you get better. So you, those two are not, they can't happen at the same time, but you could hit pause on
That's
making
fair.
the trades with real dollars. And so I might encourage you to maybe participate in a paper trade in the meantime.
Yeah. So, and that's actually, so one of the things to that point is the pause is specifically, and this was again something we elaborated on in a previous episode, that what I'm worried about on the strategy is that it's the wrong vehicle. So what we talked about with the calendar spread, it's just such a tight vehicle that I believe in the math and the statistics that were behind why to use that vehicle. But it was just not being realized in situations when it really felt like it should have been realized. So that's part of the struggle, is to reconcile. Do I stick it out in a paper trading account or something? Because you're right. Like, I mean, I still need to collect data, and I could certainly do that risk free. Because this isn't a situation where I need to be in the market to feel the risk. I'm feeling it plenty. This is a data collection thing. Versus, should I be revisiting a different strategy for earnings that might be a better vehicle? So, and the last thing I'm doing on the tour de learning is I've started to get, there were 2 books that came across my radar, and I thought they paired so well together. One of them is this thick chunker, technical analysis of the financial markets. And this is actually, it's supposedly very accessible despite its textbook size. And it's used across many different academic institutions and things like that. But it's very, as the name implies, it's all about technical analysis. And I that obviously is very interesting to me and something I'm always trying to sharpen. I feel very comfortable with my technical analysis, but that does not mean I can't keep growing. I absolutely can and should, because that journey never stops. So it felt like it was time that I had enough foundation that I wanted to bloom into some more structured material on that. The other one I don't have physically because I'm listening to it on Spotify. So that is just a plug to how accessible it is. And that book is called Trading in the Zone. And so that book is entirely, and this is why I'm listening to it instead of reading it. I actually really struggle with reading things, but that one is all about the emotions of trading, the emotions in the market. And it focuses entirely on the psychological effects of trading and how to overcome that. And so, and I want to be clear, that book has nothing to do with an edge or a strategy or anything like that. It's very much a self-reflective type of book. And in fact, I'm glad he starts out the book, I mean, literally saying, I want to assume if you're listening to this book, you already have an edge identified. And I think that was a really important footnote at the beginning to say, you need to have an edge. That's a whole separate conversation. That's potentially this technical analysis book. You need to find an edge. Emotions and even emotional control is not your edge, but emotions can completely explode your edge. And so it's that kind of symbiotic importance of both of those that I thought this book pairing was pretty solid. And as far as financial books go, it seems like it's rare to have some books that are not how to make your first million in 2 weeks, or, you know, stuff like that. So far it seems to be, I'm not finished with the trading in the zone. It just got started, but I mean, every page or chapter is like an indictment on me, because he's like, "Ooh, when you're in the market, you might feel this. I was like, I did that this morning. It was very eye opening. Of like, I knew I had bad habits, but like, it's just every single thing that you could do wrong emotionally. I'm either well aware of or actively engaging in. So that's been important to me for a, like, let's pause on super deep investigation, because honestly, edges, I mean, they're super important. But I feel like they're easy to find. And I'm saying that very loosely, because you still need to know and learn and all that stuff. But I'm not worried about how to find an edge. On this show, I've gone over 5 or 6 different edges. But it's about the emotional control to be able to actually be profitable with an edge. So definitely finding it important to take a pause and try to get that under control, because that seems to be what's really holding me back when I look self-reflectively.
Yeah, that's actually kind of interesting, because I think we've called it out on this show quite a bit about like the psychology and the emotions of trading. They're real. And in my brain, when you were kind of describing this, I equated it. I always equate things back to different automotive pieces. But then, you know, you have torque and horsepower in your vehicles, right? And the torque is a lot of times what gets you there, like the speed. It gets you to the speed that you want to travel, right? So the higher the torque, the faster the acceleration, the faster the vehicle can get you going and get moving. And then horsepower is really what keeps you there. And I almost think that there's an analogy there to your edge and your psychology. I feel like your edge is what gets you there, but that trading psychology is what keeps you there. And so I really think that not having that trading psychology, or being very sensitive to that, and kind of emotionally influenced, will really, really completely negate, nullify, dull out your edge, because it can really overpower. You really only need to get your car up to a particular speed, but it's more important to keep it there to win a race. It's like, you know, if you're in a big race, you know, you don't need to constantly be accelerating, right? You just got to accelerate and then stay there.
Yeah, no, I think that's a really good analogy. And at risk of breaking it, I would say logging everything is your cruise control button. That's what just locks it all in. But yeah, I would highly recommend the trading in the zone, honestly, to anybody at any level, as long as you're interested. Maybe not until you've okay, so maybe not anybody, but like once you've taken a few trades and you've actually started to put some money on the line and started to feel some emotions, that's when it's applicable to jump in, because you know, to sum it all up in a teaser of like what is interesting about it is, in the one chapter I was listening to today, said that the profitable traders in any market, it's a very small percentage. Most are very unprofitable traders, but the profitable traders are the ones that go into a position and out of a position and feel nothing. You don't, you know, whether it's a loss, whether it's the biggest win you've ever had, if you're sad and dejected, or if you're super psyched and jumping around, and then he unpacks all of these real psychological things our brain does when we're feeding that dopamine, or when we're ingesting that fear, and how that actually manipulates how we view the next opportunity. And so I feel like I mean, you don't have to be in the market for long to relate to any of that.
Yeah, I can definitely 100% agree with that, Viper. But anyway, that's going to bring us to the end of this week's episode. Really just a reaffirmation that the searching and learning never stops. Pretty much, I'm always kind of learning new things. Viper's not learning new things. I'm always searching for the trades. Sure, I've dialed in my strategy. I'm kind of rinse and repeat, but definitely going to have to check into at least that emotional trading book that you're talking about. I always like kind of listening to those things and hearing them. I'm not sure I need quite the sleeping material as that other large book that you had, but maybe I'll take a look at a synopsis of that. Thought you were going to pull that out and say, this is my bedtime reading. I'm like, yeah, I'd probably fall asleep too. Anyway, that stuff's a lot more exciting as you're experiencing it, but it's really about finding what you're interested in and really keep drilling into it, you know. And so I just want to encourage you guys to keep after it. Maybe you haven't found your niche, maybe you haven't found your shtick on things. Keep trying, keep looking, because I really do firmly believe, and Viper, I believe we've also talked about this before, that kind of this investment, this trading, is really one of the more solid paths to building kind of wealth. And it's not for everybody. It's not something that just magically happens. You have to kind of want to do it. You have to work at it. And it's not oh yeah, just watch this YouTube video and you'll be good to go. It does take a little bit in there. And, you know, I've talked in past episodes, what's my time commitment a week? But I feel like if you're really, really after it, you can carve that out. And, be happy to talk with anybody in the Discord if you want to hop in there and chat a little bit. Otherwise, good luck out there. Have fun. And remember, think outside the block.